My name is Christopher Aaron. The company is iGold Advisor. We work with individuals as well as mining companies and high net worth individuals to strategize on the precious metals markets. Before I go any further, I just want to take one moment to dedicate this talk to my father, who just passed away 2 months ago, and he actually bought me my first Silver Eagle in 1987, and so it's kind of appropriate that this is happening now. So I want to cover the state of the gold market in 2019 and going forward into 2020. This is not going to be what you hear from most other people, which is just, this is why you should buy. As you know, I own that same Silver Eagle back from 1987, so I'm bullish on the sector over the long run. But there are some cautionary signals over the next 6 to 12 months that I want to let you know about, and you may want to consider some defensive action. So let's take a look at it. Major topics we're going to cover today. There are higher gold targets coming for the next 6 to 12 months. I want to show you exactly what I'm looking at. I think there's a significant potential here for profit over the next 6 to 12 months especially. And then we have these omens setting up for 2020. I think some defensive action is going to be better than no defensive action. This might be a multi-year correction setting up. Is it part of a longer bull market? We will see. I work with individuals. I just like to protect the best interests of investors. So I just want to talk briefly about the philosophy here that I come from. My background is in working with the military, and so it was cut to the chase. What's the point? Don't give me a whole lot of facts until I know what the point is. And so we could look at things like this. We can look at world gold supply and demand. We can talk about the fact that in 2018, this was the highest extraction of gold from the Earth's crust in the history of humankind, right? Over 3,300 tons. Pretty significant. We could talk about these other fundamentals, jewelry fabrication. We can talk about the fact that 2/3 still approximately of the demand for gold comes out of Asia. Physical coins and bars, look at where we are, North America, 4%. It's nothing. So this market is highly outside of these countries. We could even talk about the dreaded M word, manipulation, right? And just for the record, I think there is manipulation. Of course, there has to be for this monetary asset. But there's manipulation in all markets, and so I think we should incorporate the manipulation into our game plan and not act as victims. Okay? These are all fundamental data points. I just want to get rid of those for a moment and show you where I come from with this, which is, if we look at supply and we look at demand and we talk about where do all these things come together, the price. This is macro econ 101. So I say if we study the price above all else, we get a more accurate representation of what is actually happening in this market versus studying one of how many? How many fundamental data points are there? Are there 10? Jewelry, supply and demand, mine output. Are there infinite fundamental data points? Are we talking a ratio of 1 over infinity? So I say we simplify things into studying the price. That's my philosophy. Price and price alone. So let's look at it. The gold price going back from 2011, I want to tell you in the highest probability sense. This is how I would brief military commanders in Afghanistan when I was there in 2009. What do we say? What are the takeaways? We look at this. This is the gold price from 2011 to the present. There was a peak in 2016, $13.78 per ounce, right? That peak was hit 1, 2, 3, we can call it 4 times, and then we finally had this breakout just 4 months ago. Significant breakout. Flat, horizontal, we had sellers coming in there every time. What was there? A general rising trend in the buyers. So when you have sellers coming in at a certain level and buyers rising, this is what we would call in technical analysis, this is a rising triangle, an ascending triangle. And the point of this, when we're talking about measuring targets, we can actually calculate a projected target. These are fairly accurate. Okay, we can talk about the amplitude of this 2016 surge. This was a $333 amplitude off the low. And there are shorts who are trapped right now because they're underwater. They were shorting gold on that rise. They're underwater, and we are going to have some short covering. It is not done yet. And so this gives us higher targets. The first target is 1711 for gold. This is based on that amplitude measurement. If we actually extend this back and look at this base here that formed, we're talking about, this was not just a 3-year base. I mean, there was a significant surge in 2016, but we're talking about a 6-year base here for gold that has just broken out. Where was the actual breakout of the base? Right there, 1435. Let's talk about the amplitude of the entire base. There are shorts who have been thinking gold was going to go down to $900, $800, $700 an ounce. They are scared right now. They are going to be covering over the next 6 to 12 months. At some point, you have to cut the pain. These could be companies, mining companies that are closing their hedge books. These could be individual institutions that were short. These could be momentum chasing buyers who come into this market. Right? So we have a higher target when we calculate the amplitude of that entire base, $1,823. This is what I'm looking at for the price of gold coming up over the next 6 to 12 months. Do we have any confirming or denying information? Of course we do. I just want to show you one more data point. I realize there's a lot of information here on this chart. We're looking at the Japanese yen on top. We're looking at the price of gold on the bottom. You say, well, who cares about the value of the Japanese yen versus gold? What does it matter? Just look at the two charts for a minute. Just look at the major takeaways. If I had the little laser pointer, I would do that right now. I don't think I have it. Look at the 2011 top. Japanese yen on top. Look at gold on the bottom. 2011 top. Look at the waterfall decline in 2014. Look at the major low in 2015. Look at the consolidation, all right? The market was saying that the Japanese yen and gold are functionally equivalent. They are being considered the same asset class by the market. We can disagree. We can say, well, a fiat currency, there's no way that this is the same as, the 5,000-year-old store of wealth. We know that from a fundamental data point. But the market here is telling us something different. There's another way we can look at this as just a ratio, right? The Japanese yen versus gold plotted as a ratio. Look at the flat line in that ratio, the blue call out. Something new is happening. Zoom this in for a second. What is this? There was the zoom in of the flat relationship between gold and the Japanese yen. That is a major, major breakdown in the ratio of the Japanese yen to gold. What? In favor of gold. So something is happening here. Something is changing in favor of gold. Let's flip this upside down for more usable English terms. We're talking about gold as priced in Japanese yen now. This is like how we would use it as human beings if we were in Japan buying and selling gold. This gives us a target of 181,000 yen. Right now we're at 161,000. Very reliable technical pattern here. When you see a 9-year converging consolidation like this that breaks out, very reliable pattern. This is going to be, you look at that breakout there in red, one of the most clear breakouts I can ask for. We're going to have higher prices coming in gold as priced in Japanese yen, just the same as gold in US dollars over the next 6 to 12 months. And I propose to you that these data points are probably going to converge. A target for gold in US dollars, 1711 to 1823. Let's consider it a range. We're at least $200 higher than we are today at 1500 over the next year. And that gold and Japanese yen target coming in at the same time. So I think a lot of these, especially some of the junior mining companies, are valued right now at less than their 2016 peak. We have companies that are sitting on defined deposits. The gold is already proven in the ground, but they're trading at 1/3 of their 2016 peak. Why is that? I propose to you there's a significant potential for revaluation as gold hits some of these higher targets over the next 6 to 12 months, let's call it. Intermediate term opportunity setting up here. However, after those higher targets, this is actually the meat of what I want to present to you today. There are some warning signals. I would say this is appropriate for the season that we're in. We're talking about Halloween. You know, and we have, it's like when there are warning signals, we'll look at the 2011 example, the top in gold. You have two options, really, when there is negative data being presented to you. One is you can bury your head in the sand. You know, the ostrich takes this route out of scary situations. The second is to confront it head on and say, what do we actually have in front of us? And what should we do to protect ourselves after these higher targets over the next year? This is the key. Okay, we're looking at the top. This is gold on the top. We just looked at that. And on the bottom, same time frame, the companies that dig that very product out of the ground. There should be some relationship between the product and the companies, right? What's the only problem? We have a major breakout in the price of gold, and where are the companies relatively speaking? So gold is 10% higher than its 2016 peak. The companies are now 20% lower still across the board. We're talking senior large cap miners that are posting revenues, posting earnings per share that are higher than their 2016 peaks. What the heck is happening here? That's the HUI gold mining index. We're talking about 30 of the largest unhedged gold mining companies in the world. Why are they trading at this discount? I want to show you one example from history that is blacked out for a reason. This is, we're looking at the last time this signal appeared, exactly the same as it's appearing now. Gold 2010 to 2015. Look at this rise here from 1400 to 1550 in the price of gold. And look at how the miners moved flat for that time. Let's get rid of a little more time. The move to the peak. Both of those arrows for gold, we're talking gold from 1400 up to 1900, and what? The miners are flat into the peak, the highest price for gold in the history of mankind. And the miners discount the entire thing into 2011. Now, I was participating in these markets. I was investing heavily at this time in 2011. I was taking extensive notes, listening to all the gurus at the time. And people were coming up with every explanation under the sun as to why this divergence was happening. You know, people talking about oil prices going higher than gold prices, extraction costs, debt is skyrocketing in the gold mining companies, grade is going down, fill in the blank. I'm sorry, there was only one right answer, which is that the miners were predicting ahead of time a 50% decline in the price of gold and an 80% decline across the large caps into that top. All right, that's the power. I just want to bring up the current example, lest we not fall prey to the "this time is different" fallacy. It typically isn't different, as John Templeton, the famous investor, has warned us. Here's the current example. Once again, there we are seeing it. So how do we take this? I have talked about higher targets over the next 6 to 12 months. I think a lot of these small cap companies could double or triple in this last $200 to $300 rise in the price of gold. But right now we're seeing these warnings. And just to quantify what I'm thinking here, I can talk about a warning. We could talk about gold coming back down, let's say from 1800 back to 1300. You know, 1800 back to 1000. Maybe it makes a giant double bottom. Maybe silver comes back to $13 an ounce. I'm not talking about a collapse. You know, there are some other colleagues, I won't mention their names, that are talking about gold falling down to $300 an ounce or 500, silver falling down to 4. I'm not talking about that. It doesn't have to be that. But what we're asking is the question, is this the bull market right here and right now? And if you want to participate in the bull market when it happens, you should pay attention to some of these signals and consider some defensive action into the next year. Some is better than none. There's one other quick data point that I want to show you here. I realize this is scrunched. I usually work with PDF formats, and so we have, you can zoom in really close on this. I have 3 minutes left, so I'll just show you what we're looking at here, and then we'll sum it all up. This is the gold to silver ratio on top, the price of gold in the middle, and the price of silver on the bottom. 1971, the beginning of the freely traded era, through 1987. There's the peak in gold at 850, that big spike in the middle. There's when the Hunt brothers cornered the silver market in 1980. And there's the gold to silver ratio on top. And if you just see that, where I'm saying legitimate breakout there, notice as the gold to silver ratio was breaking upward, that was an all-time high resistance zone. The number of ounces of silver required to purchase 1 ounce of gold, it was breaking upward in 1987 as gold made a 90% advance off of its low. The low was $275 per ounce in 1985. It rose back to $525. That's like gold getting back to 1900 in today's terms, 90% advance. What was the result of seeing this warning signal? The warning signal was the gold to silver ratio breaking out in red. I'm sorry to say it, so it was predicting when you see silver not participating in a gold advance, that was a prelude to a 13-year bear market for both gold and silver. Let's juxtapose that. That's the historic example versus the current example. What are we seeing right now? Upper right, the big far right. This is the gold to silver ratio breaking out as gold is now approximately not 90% above its low, but only 50%. It hasn't even done anything near where it would happen in the 1980s. And silver kind of whistling past the graveyard at this point. There are positive signals, the positive signals we've talked about. There are higher gold targets to come over the next 6 to 12 months. I'm very confident about this. I think there's going to be something of a mini stampede into some of the undervalued mining companies as gold reaches these peaks. I think you're going to see the first hint of the mainstream investors start to come into this sector. This is what I'm positioning for right now myself. I have clients who I'm positioning in this way. After we hit those peaks, there are significant warning signals, and I believe the prudent precious metals investor and the prudent mining company is now going to start taking some consideration of these warning signals. The last signal we saw like this was 2010 into 2011, the top of a 5-year before a 5-year bear market. I mean, we can ignore it if we want to, but I would say for those who preserve capital into the next peak and then buy in as the next low is coming, I think represents the opportunity of a lifetime coming early 2020s. I don't think it's going to be that far from now. So this is the state of the gold market 2019 into 2020. As I see it, as I'm advising clients, and I want to ask you to consider focusing on price and price alone as opposed to, let's just say, 1 or 2 fundamental data points that are not leading us in the direction of what we actually see on the charts. Thank you very much.